Hello everyone, Assalamualaikum warahmatullahi wabarakatuh. Okay, guys, this video I will explain for the chapter 4 under the course of International Finance Management, IFM, or FIN542 for your ATM student. Okay, this chapter will explain the foreign exchange market. Alright. Let's look at what is the foreign exchange market. First of all, you have to know the definitions of exchange rate. Okay, definition of exchange rate. What is the exchange rate? An exchange rate is the value of one nation's currency versus the currency of another nation or economic zone. Okay, the value of one nation's currency versus the currency of another nation or economic zone. For example, how much Malaysia ringgit does it take to buy $1? As of October 24th, 2022, the exchange rate was 4 ringgit and 74 cents, meaning it takes Malaysia ringgit 4.74 to buy $1, as we quote as Malaysia ringgit 4.74 per $1. Just like other commodities, currencies also are bought and sold. In market, we call as foreign exchange market. The world's three most common transactions are exchange between dollar and euro, which is around 30%, dollar and yen, 20%, and dollar and pound sterling, 12%. And over time, exchange rate change, and due to these changes, forex traders experience profits or loss in their foreign exchange trading. How currency values are established depends upon whether they are determined solely in free markets, we call as freely floating exchange rate, or determined by agreement between governments, we call as fixed exchange market or pegged exchange rate. Please remember, every time we need to exchange between currency, meaning we are either buying or selling the currencies. For example, if we want to exchange Malaysia ringgit 100, 100 ringgit to US dollar, actually we are buying US dollar. Currency's value largely determined by the interaction of demand and supply. Do you still remember the demand and supply theories? Okay, similar to demand and supply of other goods, currency also have their own demand and supply. Okay, let's look at the first one, the demand for foreign currency. The demand for foreign currency, or the other words, we can say that supply of home currency. Okay, the demand for foreign currency, meaning the supply of home currency. The demand for foreign currencies is derived from the demand for another currency's export, or in other words, we import goods and services from another countries. For example, when Malaysia import goods or services from a foreign country, for example, I give you example, China. Malaysia will then demand for foreign currency to pay its purchases. For China, meaning that Malaysia will demand for yuan to pay its purchases. When Malaysia demands for foreign currency, which is yuan, it means it is actually supplying home currency abroad, meaning Malaysia supply Malaysia ringgit to China. Okay, do you understand? When Malaysia import goods from China, Malaysia will demand yuan and supply Malaysia ringgit to China. Demand for foreign currency also comes from speculators who are looking to make a profit on changes in currency values. So, demand is the measure of how much of a particular commodity people want at any time. Demand for a currency has the opposite effect on the value of a currency than the supply. As the demand for a currency increases, the currency becomes more valuable. Okay, do you get it? If the demand for Malaysia ringgit increase, the Malaysia ringgit becomes more valuable. Okay, conversely, as the demand for a currency decreases, the currency becomes weak or less valuable. Okay, alright. I hope you guys will understand the demand for the foreign currency, or other words, the supply of home currency. The second one is the supply. The supply of foreign currency, meaning that the demand of home currency. Let's look at. The supply of foreign currency is determined by the increasing of home export. Okay, for example, when Malaysia export or sell goods or services to foreign countries, they will have to supply their currencies in order to buy our Malaysia ringgit. They here refer to foreign countries to pay their purchases. Okay, I give you another simpler words. When Malaysia sell goods or export goods to USA will supply their currency, which is US dollar, to buy Malaysia ringgit, to buy our Malaysia ringgit to pay for their purchases. Okay, so they supply US dollar to buy Malaysia ringgit. So they demand our home currency. The more they import, the greater the supply of foreign currency to our home country. Meaning that as the supply of currency increases, the currency becomes less valuable. Conversely, as the supply of currency decreases, the currency becomes more valuable. Okay? Do you understand? Alright. Let's proceed to the next slide. I think we can be more understand when you see the seesaw of the supply and demand. The seesaw of supply and demand has two sides, the right side and the left side. Okay, so based on this diagram, this is a balanced supply and demand. This one is demand side and this one is supply side. The left side represent demand and the right side represent supply of one currency. Let's say we export goods. We here refer to Malaysia. Export goods to USA. In this case, US demand for Malaysia ringgit because it needs to pay for our goods in Malaysia ringgit. Therefore, the seesaw will look like this. USA demand for Malaysia ringgit. So, this seesaw is for Malaysia ringgit. And more demand for Malaysia ringgit, meaning that the left side becomes more weak, increasing in supply. If the demand increase, the supply for US dollar will decrease. So when this happens, fundamentally speaking, the Malaysia ringgit should be increasing in value. An easy way to remember this is by looking at the slope of the seesaw. You can see that is the upward from the left to the right. This is positive slope and indicates the strength in the Malaysia ringgit. Okay. When we export goods to USA will demand more Malaysia ringgit. So here, Malaysia ringgit will be increased and the value in the Malaysia ringgit becomes stronger. Example, if we import goods from US, we here again refer to Malaysia. Malaysia import goods from US. In this case, Malaysia demand for US dollar because we need to pay for the goods we import in US dollar. Okay, we import good, we buy good from US. So we have to pay the goods in US dollar. Therefore, if we demand US dollar, meaning that we have to increase the supply in Malaysia ringgit. So the right side will be more weight. Okay, increase in supply and decrease in demand. Again, an easy way to remember this is by looking the slope of the seesaw. You can see that it's a downward sloping from left to right. This is the negative slope and indicates the weakness in the Malaysia ringgit. Now we look at the exchange rate equilibrium. I think you found the equilibrium in market equilibrium, firm equilibrium. That is a similar theory. Equilibrium is the rate which equates demand and supply for a particular currency against another currency. Similar to the market equilibrium, we have the point of equilibrium is the intersection between the demand and supply curve. Now, I give you one example. If we assume the UK and France both produce goods that each other wants, they will wish to trade with each other. However, French producers require payment in euros and the British producers require payments in pound sterling. Both need payment in their own local currency so that they can pay their own production costs in their local currency. The foreign exchange market enables both French and British producers to exchange currency so that trades can take place. The market will create an exchange equilibrium rate for each currency. So let's look at the exchange rates equilibrium. We have the supply and demand curve, and the point of equilibrium is at the intersection between the demand and supply curve. As for the example before, we can see that this is the exchange rate pound per US dollar, meaning 1 pound is equals to 1.5 US dollar. Okay, now we move to the exchange rates or price quotation. How we quote the price in the exchange rate. Okay, when interbank trade involve US dollar, for this case, we use US dollar and euro. Okay, so if you look at this, there are two countries, US dollar, USA, and Europe countries. So these rates will be expressed in either American terms or European terms. Let's say, for this case, the home currency is US dollar and foreign currency is euro. So in American terms, we can say that US dollar 1.2500 per euro, meaning units of US dollar home currency per units of euro foreign currency. For European terms, it could be euro 0.8 per US dollar, meaning units of foreign currency per 1 units of home currency. In dealings with commercial customers and non-bank customers, banks in most countries use a system of direct basis quotation. Okay, let's look at here. There are two types: quotation, direct basis, and indirect basis. For direct basis, quotation that quotes the price of home currency per 1 unit, for example, 1 US dollar, 1 euro, 1 pound sterling, or 100 units of foreign currency. Some countries use 100 units, for example, Japanese yen, Thai baht, Indian rupees, and also Indonesian rupiah. Okay, we look at as Malaysian perspective. For example, from Malaysian perspective, Malaysia is home currency. So how we quote the exchange rate from Malaysian perspective? Okay, let's look at the first example, the Malaysian ringgit versus US dollar, meaning Malaysian ringgit 4.1250 per 1 US dollar. Okay, we can say that US dollar, one US dollar equals to Malaysia ringgit 4.1250. Okay, or 400 units of foreign currency, we compare the Malaysia ringgit and Japanese yen. So for Malaysia ringgit, 3.0807 over 100 Japanese yen, meaning 100 Japanese yen equals to ringgit Malaysia 3.0807 is the direct basis quotation. How we differentiate with indirect basis quotation? Okay, for direct basis, home currency per foreign currency. For indirect basis quotation, quotation that quotes the price of foreign currency per home currency. Okay, price of foreign currency per 1 unit or 100 units of home currency. Okay, for example, again, from Malaysia perspective, Malaysia is still the home currency. So, per 1 ringgit, US dollar is 0.2424 or Japanese yen 32.4602 per 1 Malaysia ringgit. Okay, so here is the difference between the direct basis quotation and indirect basis quotation. And we always see the quotation is direct basis quotation when we want to exchange our currency. Okay, so that's all for this video. We will proceed to the next video. Thank you.